Most people still believe that tomorrow will be similar to today. Warren Buffett thinks differently, and he made a warning. Most people are unprepared for what is coming, and those who ignore this movement will be swallowed by it. In this video, we will reveal the most common mistakes, Buffett's real strategies, and how you can prepare. So stay until the end. Just before we start, remember to like the video and subscribe to the channel so you don't forget. Imagine opening the ranking of the 20 largest companies in the world today and discovering that in 30 years, none of them will still be at the top. Does that seem excessive? Warren Buffett asserts exactly this. And it is not a prediction, it is a historical fact. In 1989, names such as General Electric, IBM, and Exxon dominated global markets. Today, none of them appear among the leaders. 0 out of 20. This data, often ignored, serves as a direct warning. Business stability is an illusion. Even seemingly indestructible corporations lose relevance, and those who invest in them, believing they are eternal, face a silent risk. Buffett reminds us that the only constant in the market is change, and that, no matter how solid they may seem, giants do fall. General Electric was a symbol of industrial excellence for decades, but lost its place for failing to adapt. The same can happen with companies that are currently seen as unquestionable. Apple, Amazon, Alphabet. None are above the law of economic entropy. An even more illustrative example comes from the automotive industry. In the early 20th century, more than 2,000 companies in the United States attempted to profit from the automobile craze. Only 3 survived. 2 nearly went bankrupt during the crisis of 2008. The question that remains is, if yesterday's leaders have disappeared and today's are at risk, what should a sensible investor do to avoid repeating the same mistakes? And more importantly, where exactly is the blind spot for most? Buffett has provided clues, and they lead us directly to the next insight. Many investors believe that identifying the right sector is enough to ensure good results. However, as Buffett shows us, this is far from being true. A sector may be on the rise, transforming the world, and still lead thousands of companies to failure. Buffett warns, do not confuse a good story with a good business. This mistake is repeated time and again. Today, sectors such as artificial intelligence, renewable energies, and crypto assets are surrounded by enthusiasm. They are indeed promising areas. But that does not mean that every company in these markets will succeed. Many do not even generate profit. Others lack a clear business model. The problem is that the average investor buys into the narrative. They see headlines, promises, impactful interviews, and forget to look at what really matters. Margin, cash, return on capital, or debt. The right sector with the wrong company is still a poor investment. Therefore, even when the future seems obvious, prudence remains irreplaceable. Skepticism, not naive optimism. And if you are starting to realize this, wait until you see why the majority still insist on doing the opposite, even when the outcome is already predictable. Choosing individual stocks seems like a noble art. For many, it is almost a personal challenge. I can beat the market. But the data tells a different story. In practice, most investors who try to pick the best stocks end up trailing behind the very market they aim to outperform. Warren Buffett is direct about this. He recommends that 90% of the inheritance left for his wife be invested in a fund that replicates the S&P 500. That's right. The greatest investor in history prefers a passive strategy to protect his family's wealth. And it is for good reason. Over the last 40 years, the S&P 500 index has delivered a gross average return of around 10% per year. Few funds manage to beat this number consistently. Even fewer do so after fees are deducted. For the average investor, who does not have the time or resources to analyze companies in depth, the chance of outperforming this performance is minimal. This is because the market is efficient. Public information is already reflected in stock prices. In other words, when you buy a stock thinking you see something others have missed, you are likely already too late. Fortunately, there are rational alternatives. ETFs that replicate the S&P 500, or global funds like the MSCI World, which offer broad geographical diversification. The ideal strategy? Not to try to predict. Just to remain exposed and let time do the work. because fewer decisions mean fewer mistakes, and in practice, more results. But what if there were a way to make this approach even more robust? Many people still believe that investing well requires genius, free time, and complexity. However, in practice, the most efficient strategies for the majority are the simplest. And this is not a shortcut. It is applied financial engineering. Passive funds, such as those mentioned in this video, offer 3 advantages that are hard to surpass. First, extremely low costs. While active funds charge up to 2% per annum, passive ETFs can operate with fees below 0.1%. This difference, over the long term, becomes an abyss in the final yield. Second, when buying a global ETF, such as the MSCI World, the number exceeds 1,500 companies in more than 20 countries. No individual investor can achieve this diversification alone. Third, and perhaps most importantly, consistency in results. According to the report, more than 80% of active funds in Europe underperform their benchmark indices over 10-year periods, and even those that outperform rarely repeat the feat. Warren Buffett openly criticizes this model. Managers who promise to beat the market, charge high fees, and deliver less. He knows that for 99% of people, it is more effective to simply track the market with discipline. If you do not have time to study balance sheets or foresee economic cycles, do not try to appear clever. Just be consistent. Automate your contributions, reinvest dividends, and stay the course for decades. Because the best strategy is not the most sophisticated. It is the one that you can maintain reasonably over the long term. But how can you make this strategy even more solid, even in the face of crises and unexpected opportunities? Buffett has a practical answer. While many seek the next big bet, Warren Buffett does the opposite. He accumulates cash. Today, Berkshire Hathaway holds more than €300 billion in liquidity, the largest amount in the company's history. Buffett does not attempt to predict the market. He observes, waits, and acts when the price is in his favor. This approach does not depend on genius. It relies on discipline. It is about following fundamentals, maintaining a long-term focus, and ignoring the noise of passing fads. The good news is that this model can be adapted for individual investors. With a simple and rational allocation, consider this portfolio capable of outperforming the market while also protecting you from crises. 60% in diversified funds. This portion is the engine of growth. The idea is to capture the average performance of the global market with low cost and wide diversification. 20% in commodities, such as gold or oil. These assets tend to appreciate during inflationary crises or geopolitical shocks. They protect the purchasing power of your wealth. 20% in liquidity, with investments that are easily redeemable. This portion serves to take advantage of opportunities when the market declines sharply, just as Buffett does with his cash. This portfolio offers 3 pillars: growth, protection, and flexibility. You do not need to predict when the next crisis will come. You just need to be positioned to weather it and capitalize to act when others are paralyzed. But what if you do not yet have this cash reserve? How can you start from scratch with safety and realism? Buffett also gives us clues about this. It is hard to imagine, but one of the richest men in the world leads a simple life. He has lived in the same house since 1958, drives an ordinary car, and has breakfast for less than $5. This is not by chance. It is philosophy. The reason is clear: control over one's own time and security to act when the opportunity arises. Maintaining a low cost of living is one of the greatest shields against financial instability. The less you need to live, the less vulnerable you are. I will show you with numbers. If your monthly expenses amount to €2,000, an emergency fund for 6 months requires €12,000. Now, if you spend €3,000, you need €18,000. If your monthly income is €3,000, living on €2,000 allows you to save €1,000 per month. That is, every 2 months, you manage to save the equivalent of 1 month of your income. However, if you can only save 10% of your income and live on 90%, it will take you 9 months to accumulate the equivalent of 1 month of expenses. The lower your cost of living, the faster you accumulate. Thus, saving the equivalent of 6 months of expenses may take 54 months in the first case, but only 12 months in the second. The difference lies in lifestyle, not in income. So where to start? Eliminate invisible expenses. Subscriptions you do not even use, revolving credit interests, unnecessary bank fees, small daily wastes. Classify your expenses using the 3-budget rule. Essential, such as housing, food, health. Comfort expenses, for moderate leisure and useful subscriptions, and superfluous expenses, such as impulsive purchases. Eliminate all superfluous expenses for now, and filter to keep only the comfort expenses that fit within your budget. But that is not all. Save at least 10% of your income. Once you adapt, move to 15%, then 20%. What matters is to start, because the only certainty about moments of panic is that they will come. And when they do, those with liquidity do not panic. Buffett does not wait for chaos. He prepares for it. And you can do that too. As Buffett warns, the majority will not be ready. But I imagine you are different. Comment below. What are you doing today to prepare? If this content has helped you see the scenario that is forming, like the video and subscribe for more content on finance. Because if even Buffett is cautious, perhaps you should be too. See you in the next video.